Good day, this is the Asymmetric Daily Brief for Monday, August 10th, 2026. Here is the shape of it. Michael Saylor sold Bitcoin, not much of it, 1,690 coins, about $108.6 million, but he sold it at $64,262 a coin against his own average cost of $75,385. He sold at a loss of roughly $18.8 million and handed the proceeds straight to his preferred shareholders. The internet spent the day arguing about his conviction. That is the wrong question, and we will show you the right one because it is sitting in 2 lines of a quarterly filing that almost nobody quoted. Then the board, 3 places we think consensus has this backwards: the macro regime, sentiment, sectors, the calendar, and the calls. The board, the S&P 500 sits near 7,766, up about 0.1%, hugging Friday's record close. The Nasdaq Composite slipped roughly 0.3% from Friday's 26,690. The Dow is flat, near 54,040. The 10-year Treasury yields 4.65% and hold that number because it is the genuinely fragile asset today. Gold sits somewhere between $4,335 and $4,420 an ounce depending on the venue you read, and we quote the level and the driver rather than a percentage, because the percentages circulating are contested. Bitcoin is near $64,174, down about 1.5%, and importantly, below Strategy's own average cost. West Texas Intermediate is near $78. Brent near 84, both having given back gains of nearly 3% from earlier in the session. The dollar index closed at 99.54, down 0.4, and it lost the 100 handle, one number to carry alongside all of it. On last week's readings, the top 10 companies remain more than 40% of the S&P 500. A record index level is still a statement about 10 companies. Consensus versus the asymmetric. First read, and it is the most important thing in this brief. Everyone believes Michael Saylor sold Bitcoin because he lost his nerve. The man who built an identity on never selling, blinking. That is the story that traveled. The filing says something completely different. It says he was a forced seller, and the force was not the Bitcoin price. It was a dividend. Here are the 2 numbers. In the second quarter, Strategy's software business booked $122.4 million of revenue. Over the same 3 months, the company owed $400.7 million in preferred dividends. The dividend bill is 3.3 times the entire top line, and the direction of travel is the part that matters. A year earlier, those same 2 lines read $114.5 million of revenue against $49.1 million of dividends. Dividends were less than half of revenue. In 12 months, revenue grew about 7%, and the dividend obligation grew 8.2 times. Both figures come straight from the company's own quarterly filings with the Securities and Exchange Commission. This is not an estimate, and it is not our model. It is arithmetic. So how was that bill ever payable? By issuing stock above the value of the Bitcoin behind it, buying more Bitcoin, and letting everyone own more coins per share. That works while investors pay a premium. Strategy carries roughly $15.4 billion of perpetual preferred stock across 4 listed series, and perpetual means the dollars are owed forever, regardless of what Bitcoin does. In late June, the premium vanished. The company's market net asset value, or MNAV, fell below 1 times, and the stock now trades at roughly a 21% discount to the coins it holds. Below 1 times, issuing shares to buy Bitcoin destroys value instead of creating it. Management's own capital policy says as much. So the door closed, the bill stayed, and the bill got paid out of the asset. That is the whole mechanism, and it is why we called this issue the dividend bill. Second read, the July jobs report was genuinely soft. Payrolls fell by 23,000 against expectations of a gain of roughly 83,000, and the 2 prior months were revised down by a combined 103,000. Every instinct trained over the last 15 years says that means the Federal Reserve rides to the rescue. The tell says the opposite, and it is not subtle. As of August 9th, futures put the odds of a quarter-point rate hike in September at roughly 55%, with about 45% on a hold. A cut is not meaningfully in the distribution at all. Read that against a negative payroll print, and you have the uncomfortable version of this market rather than the comforting one. 3 members of the Federal Open Market Committee already favored hiking at the last meeting. The federal funds target is 3.5 to 3.75%, held on July 29th, and the next decision is September 16th. There is one more wrinkle worth knowing. The unemployment rate actually fell to 4.1% from 4.2%, but it fell because the workforce shrank, not because anyone was hired. July's losses concentrated in local government education, down 50,000, and retail, down 19,000. And the 12-month average monthly gain is down to about 34,000. That is a labor market decelerating rather than cracking, which is exactly the condition that lets a central bank keep watching prices instead of payrolls. Third read, and this one is the most investable idea on the board. The story of the last 2 weeks has been that open weight models are closing the gap on the frontier laboratories. Today, 3 independent parties said the opposite without coordinating. Meta shipped open weights for a 30 billion parameter model that runs on a single consumer graphics card. Jensen Huang argued that closed frontier models are actually cheaper once you honestly price fine-tuning, maintenance, guardrails, and safety. And Cassie Wood argued that open weights are becoming a reason the frontier laboratories capture most of the revenue, not less of it. 3 of the best-informed parties in the industry converging on one claim. Commoditizing the floor may widen the moat at the top. If that is right, the consensus trade in artificial intelligence software is mispriced in a direction almost nobody is positioned for. Follow the money, start with rates, because everything else hangs off them. The market's September distribution is high core hold, and it stayed that way through a negative payroll print. That tells you the inflation side is driving. Consensus Core Consumer Price Index runs around 2.4 to 2.5% year-over-year, with roughly 0.2% expected month-over-month on Wednesday. Morgan Stanley's Jim Caron offered the most useful framing on the tape today. Nominal growth is carrying earnings, roughly 6.1% in the first quarter and 7.9% in the second on the gross domestic product deflator, against a recent norm nearer 4. So a rate hike lands as a bond market event, not an equity market event. Say that plainly because it is the actionable part. The fragile asset here is duration, not the index. The dollar and the cash pile. The dollar index lost the 100 handle, closing near 99.54. Meanwhile, roughly $8 trillion sits in money market funds and has not rotated all year. State Street's chief executive Yih Sin Hung called cash a durable asset class, and that is the single most important fact about positioning right now. The marginal dollar is being paid to wait, and it is waiting. Institutions are not choosing between risk and safety. They are barbelling, with artificial intelligence growth on one end and fixed income, gold, commodities, and private credit as the anchor. Which brings us to gold, and the least price-sensitive buyer in the market. Central banks bought a net 288.9 tons in the second quarter, the largest second quarter ever recorded, and they did it in a quarter when the price fell. A survey of 76 central banks found 89% expect their gold reserves to rise, a record share. That bid does not chase momentum, and it does not leave. Crypto, price down, plumbing up, and one piece of misinformation worth naming. Bitcoin traded near $64,174, and the tape absorbed 2 separate Treasury sells Bitcoin headlines today. One of them was not news. Marathon's widely shared $1.6 billion sale is a cumulative first-half figure disclosed in a quarterly filing. 23,093 coins at an average of $70,631 over 6 months. It is not a fresh sale. The company held 35,577 coins at June 30th against 53,822 at the end of last year. Recycled filing data, dressed up as breaking news, is precisely how a false capitulation narrative gets built. And today you had one real forced sale and one imaginary one circulating side by side. Underneath the noise, the plumbing looked constructive. Roughly $1 billion of fresh stablecoin liquidity was minted to an exchange, and positioning data showed hedge funds on the CME flipping net long Bitcoin futures, which is rare because the basis trade keeps that group structurally short. Energy and a headline that keeps not happening. West Texas Intermediate opened up 2.9% near $80.42 on hopes of a Strait of Hormuz deal and faded to about $78.03. Brent made the same round trip. The Strait, which normally carries about 20% of the world's seaborne oil and gas, remains effectively closed, and Iran's stated precondition is that the United States lift its naval blockade first. Alongside sanctions relief and compensation for war damage, this is the fourth or fifth iteration of the same cycle. The market keeps buying the rumor of a reopening and selling the fact of Iranian preconditions. The discipline here is simple. Trade the shipping data, not the diplomacy headlines, because the diplomacy headlines have misled 4 cycles running. Artificial intelligence capital and the tell inside it. Intel announced a $15 billion equity offering with a $2.25 billion underwriter option, so up to $17.25 billion, to fund capital expenditure that now exceeds $20 billion this year, with next year guided significantly above that. The stock fell roughly 3 to 5% on dilution, after rising about 175% this year. With the data center business growing 59%, the tell is not the dilution. The tell is that the build-out is now large enough that a company whose stock has tripled has to tap public equity markets rather than fund it from operations. On sentiment more broadly, our market and social sentiment monitoring showed the commentary split cleanly today. The loudest voices were arguing about Saylor's character, while the quieter, more numerate ones were reading his capital structure. There was also a rare explicit negative position on Berkshire Hathaway from Michael Burry, on the grounds that the post-Buffett succession lacks the patience for a fat pitch, and one widely shared macro claim that without the artificial intelligence build-out, the American economy would already be in recession, we are deliberately not asserting. 2 independent sources raised it today. Neither is a primary source, and it is too load-bearing to repeat on trust. The tell, 0.43 times against 3.27 times. Those are Strategy's preferred dividends divided by its software revenue 4 quarters apart. A year ago, the obligation was comfortably covered by the business. Today, the obligation is more than triple the business. Annualize the second quarter run rate, and you get roughly $1.6 billion a year of preferred dividends, sitting on a company generating something like $490 million of annual revenue. There is no operating outcome that closes that gap. None. It can only be funded by selling equity above net asset value, and that door shut when NAV went below 1. Everything that followed, including selling coins at a loss, follows arithmetically from those 2 numbers. That is what a forced seller looks like in a filing, and it is why this is a capital structure story wearing a conviction stories costume. Sectors in play, 3 today. First, digital asset treasuries, and we are bearish structurally. The model was a premium financing trade, not a conviction trade. About 25% of public Bitcoin treasury companies now trade below 1 times market net asset value out of a universe north of 200 companies. One peer's premium collapsed from roughly 237% in July to about 10%, and another trades at a 63% discount. The read is that the second company to sell below its own cost basis turns this from a strategy story into a category story. Second, semiconductors and artificial intelligence infrastructure. The bull case is real demand, and Intel's raise is demand-driven rather than distress-driven, with data center growth of 59% behind it. The bear case is that capital intensity is now a financing story, and financing stories are rate-sensitive. The read is to own the demand while respecting the duration risk sitting underneath it. Third, precious metals, and here we are bullish for an unusually boring reason. Record official sector buying into falling prices, and 89% of surveyed central banks planning to add. That is a buyer that does not need the narrative to work. On the radar, first and above everything, Wednesday's consumer price index. That is the week's binary. Core consensus is around 2.4 to 2.5% year over year. Hotter than that, and the 55% hike probability hardens, and duration takes the damage. Second, Thursday brings the producer price index and jobless claims, and claims matter more than usual immediately after a negative payroll print. Third, Strategy and its STRC preferred. Does it recover toward par, or does the dividend ratchet step again? Any further Bitcoin sales below the $75,385 cost basis escalate this from capital management to genuine distress. Fourth, other Treasury company disclosures, because roughly 200 companies copied this structure and the second forced seller makes it a sector. Fifth, Intel's offering pricing and whether that underwriter option gets exercised. Sixth, Strait of Hormuz shipping traffic, the only indicator in that story that has not misled anyone. And seventh, September 16th, the Federal Open Market Committee, with 3 members already hawkish. The scorecard, and today we get to grade 1. Call 64C, logged a week ago, said strategy would keep selling Bitcoin. Today's filing confirmed it. We will take the point, and we will also name the part we did not call. We expected continued selling. We did not expect selling below cost basis. The mechanism turned out to be more binding than our own call assumed, and that is worth saying out loud rather than quietly banking a win. 3 new calls. Dated today, call 70A. At least one more public Bitcoin Treasury company discloses a sale executed below its own disclosed average cost by November 10th. That is wrong if none does. Call 70B. The September 16th decision is not a cut. That is wrong if they cut. Call 70C. Strategy does not resume net Bitcoin accumulation funded by common stock issuance, while market net asset value stays below 1 times. That is wrong if it does. And a note on the record, carried forward and strengthened. Our read from the last issue, that no September cut was priced, has gotten stronger rather than weaker. Hike odds moved from 43.9% on the jobs print to roughly 55% by August 9th. The close, Strategy's preferred shareholders are being paid, on time in dollars, funded by selling the one asset the entire enterprise exists to accumulate. That is not a failure of nerve. It is a structure doing exactly what it was built to do, in the single environment nobody stress-tested it for. And here is the part worth sitting with. About 200 other companies copied that structure while Bitcoin was going up. So the thing to watch this week is not Bitcoin's price. It is whether anybody else has a dividend bill coming due. Today's single thesis on why Saylor had no choice is in the focus, link in the description. This has been the Asymmetric Daily Brief. Research and education only, not financial advice. One contrarian read a day. Subscribe.